This lesson is for anybody looking to learn or enhance their skills with Fibonacci retracements. It's recommended you at least have a basic understanding of technical analysis and have a firm grasp of concepts such as candlestick charting and charting patterns. Fibonacci retracements are extremely helpful for analyzing charts of all kinds. They can be applied to a wide range of market conditions and be adapted to various trading and investing strategies. Fibonacci retracements can be difficult and confusing to learn, partly because this is such a unique analysis method. That's why this lesson will explain how to use Fibonacci retracements with greater reliability and success through explaining concepts, features, and price behavior with dozens of examples of real charts, demonstrating realistic market scenarios. Fibonacci retracements, or just Fibs for short, will cover the numbers 0.236, 0.3825, 0.618, 0.786, and 1. We won't cover Fibonacci extensions or other Fibonacci-based instruments and techniques. All examples will use fibs that look like the one on this chart. For other fib tools like fib extensions, circles, time zones, and channels, check out the respective lessons for each of them which have already been uploaded. Keep in mind the examples in this lesson are from various time ranges and markets. However, the general knowledge of applying fib retracements can carry over to whichever charts you choose to apply this tool on, regardless of when you watch this. Let's first start with how to draw Fibonacci retracements. Step 1, find a clearly defined swing low and swing high. These are points where price reversed direction in the past. Step 2, draw your fib by connecting the 2 points. In most all charting programs, you click and hold the first point. Here it is the swing high at 286.63. Then drag your mouse down to line up the fib with the other reversal point. Here it's the swing low at 252.92. When it's an uptrend, start from the low and draw towards the high. When it's a downtrend, draw from the high towards the low. In this example, it's a downtrend, so we draw from the highs at 286 down to the 252 lows. It's always preferable to use the absolute lowest or highest price in the area where price reverses. That's why the 252.92 intraday low is used here, as opposed to the opening or closing price at the swing low reversal area. After that, you're basically done. Simple as that. You have your fib drawn. Of course, that's not the end just yet. Next, we'll go beyond these initial steps. On to step 3. Confirm and validate your fib by using what could be called a confirmation or validation triangle, which is a triangle that can be drawn within a fib retracement to confirm its validity and determine how far into the future it will remain relatively reliable. The 2-part process of drawing a validation triangle starts with first confirming fib levels are valid by seeing if they line up with support and resistance levels that have already been proven in the past. That means price reversing direction or stalling at those price levels marked by the fib. When price moves past these levels, they will often do so on higher volume or with larger than normal price movements. Second, draw a diagonal line commonly called a trend line, starting from the first point you began drawing your fib from. Most charting programs have this diagonal line appear in the fib by default. In this case, it's the high at 286.63. Line up this trend line with at least one swing point between the swing high and swing low. Here, the trend line is able to contact 2 reversal points between the swing low and swing high the fib retracement starts and ends at. Finally, line up the end of that trend line with the level where the fib ended. In this example, it's the swing low reversal at 252.92. This forms a triangle where you can see past resistance and support that confirm and validate the fib retracement to be useful in the future. This gray triangle is for illustrative purposes. Most charting programs only have the diagonal line and do not shade in this triangle area. In any case, the triangle is easily visible with or without being marked, shaded, or colored. The trend line just needs to contact the general areas where reversals occurred between the swing high and swing low the fib started and ended at. Keep in mind, the purpose of a fib is to identify significant price levels that will present support and resistance in the future. Here, we see support and resistance levels were accurately identified well in advance of future price movements. The trend line isn't absolutely necessary, but it greatly enhances the reliability of fibs for several reasons. The trend line can by itself present and identify future areas of support and resistance, as well as the approximate time they will occur. In this first example, you can't see this because future price didn't make contact with the trend line. Don't worry about that. There will be examples ahead where the trend line of the confirmation triangle supports and resists price. The other reason trend lines are useful in fibs is the added context, effective time range, as the period of time a fib is most reliable based on the trend line drawn within the fib. This period of time the fib is most reliable is determined by how far ahead in time the trend line extends until it lines up with the second swing low or swing high that completes the fib. In the example, the trend line extends to approximately mid-August. After mid-August, the fib begins to lose reliability since it's at the end of the effective time range. In later examples, you can see fibs begin to lose reliability after price moves past their effective range. For extra clarity, let's go over one more example of the step-by-step process of drawing and validating a fib. This time, it will be a fib from an uptrend. Pay particular attention to the trend line and the effective time range. Step 1. Find a clearly defined swing low and swing high. These are points where price reversed direction in the past. In this example, we could use the downtrend that began at the $32 range, but here let's demonstrate an example with an uptrend. Step 2. Draw your fib, clicking the swing low at 22.73, then drag to line up with the other reversal point. Here it's the swing high 29.46. Notice here 29.46 is a valid swing point because it's a reversal point, a swing high. Even though it's not as established as other points like at 26.09 or 26.89, it's still a point where price clearly changed direction in the uptrend that started from the reversal swing low at 22.73. Finally, step 3, confirm/validate by drawing a confirmation triangle. Ask the following questions. Do the fib levels line up with areas where price reversed, stalled, or broke out with large price movements and/or high volume? The answer is yes to all the above here. So draw a diagonal or trend line, whichever name you prefer. Start from the first point you began drawing your fib with. In this case, the swing low at 22.73. Then line up the trend line to contact at least one reversal point between the start and end points of the fib. Here we have 3. Lastly, line up the end of the trend line with the second point that ends your fib range. In this case, it's the reversal high of the uptrend at 29.46. Now you have a valid fib that's been confirmed with multiple methods of validation. Unlike the previous example where the chart was reaching new highs, this chart has more price action to reference from the past. To confirm your fib levels for extra validity with these past prices before the fib started, simply extend the lines of your fib to the left. This means you draw lines to past prices on the left side. Check to see if your charting has an option to extend fib levels to the left so you don't have to manually draw lines to the left. In addition to the confirmation triangle, we can see fib levels also line up with prior resistance and support areas before the confirmation triangle. This process isn't necessary, but it gives an extra layer of reliability to the fib. Lastly, we see the end result of reliable identification of key price levels almost one whole year in advance. The reversals at the 0.236 and 0.786 fib levels in 2011 are especially notable here, with large price reversals occurring at these levels. In the case of this example, the fib would lose reliability as price moved outside the price range of the fib. Here it would be if price moved above 29.46 or below 22.79. The other scenario this fib would lose reliability would be after the effective time range was passed, and no new confirmation triangles could be drawn to reach new price levels within the price range of this fib. That is to say, the confirmation triangle could not be extended by contacting a newer reversal point between the swing low and swing high. This next part of the chart demonstrates a case where a new confirmation triangle can be drawn within the fib price range, from 29.46 to 22.79. This triangle and its trend line extend the effective time range further for a few more months, since the trend line can contact a newer reversal point in later 2011 between 29.46 and 22.79. This next part illustrates how reliability begins to decrease as price moves out of the fib price range. In this case, price moves above 29.46 in February 2012. As you can see, the fib levels still identify the approximate areas where price reverses, even after price has moved out of the fib price range and the effective time range of the trend line. However, levels are not as accurate as before when they were in the effective time range, and price had not yet moved outside the fib price range. It's a decrease in reliability and accuracy. Reversals do occur around these levels, but price often drifts around and doesn't reverse off the levels as cleanly as before February 2012. Now that you're familiar with how to properly draw a reliable fib, let's practice by looking at many examples with varying time frames and charts of different assets, in addition to stocks, such as currencies, cryptocurrencies, and commodities. Before misunderstanding the fib retracement to be perfect for predicting future price reversal areas, let's take a look at this case where even with good plotting of a fib with a valid confirmation triangle, future price won't always hit all fib levels with pinpoint accuracy. There are elements of strong validation, and some of the possible extensions of the effective time range, along with perfect contact with fib levels marked in yellow circles, and near contact or misses in blue squares. Keep in mind, fib levels are just approximations and not always guaranteed reversal points. Rather, they are more appropriately described as marking approximate areas or zones where reversals could occur. In the next example with the chart of PepsiCo stock, we see again how there are multiple possible trend lines that can be drawn within the price range to extend the effective time range. Pay special attention to the zero fib level at 8706 in late 2013 when price comes close, but doesn't touch the exact fib level where price reversed off a previous high earlier in the year. Situations like this often occur, where the previous swing point had high volume, which can slightly lower the area of resistance below the exact fib level. A more accurate line to mark resistance near this fib level is 8650, because the volume at the previous swing point is higher, contributing to more resistance potential, and it lines up closer with most of the closing prices of that prior swing point. Later contact occurs and breaks above the exact zero fib level at 8706, because the effect of the lowered resistance potential dissipated over a long period of time almost a year later. This Dow chart also demonstrates a similar kind of phenomenon, except this is the reverse. Supporting force is slightly above a fib level that marks a probable support level. The Dow is a good example because it shows famous reversals that many stock markets around the world followed in August 2015 and early 2016. Unlike the previous charts, it's enough to just mark the longest and most recent trend line that's relevant for confirming the effective time range of the fib. By now, you should be able to clearly see the possible points you could draw the trend line through to extend the effective time range. There were many during 2016. Just like the previous PepsiCo example, a major price reversal occurs slightly before the exact fib level, in this case the zero level at 15,370. The very large price movement and more importantly high volume are enough to create a situation where support potential is slightly above the exact fib level. Actually, during the reversal in early 2016, many were watching the 0.236 level at around 16,000. The best and most realistic way to have used the fib here would be to think of the larger zone between the 0 to 0.236 fib levels as a support zone. An exact entry in the 15,300s would be too idealistic. Although the 0 level is the absolute low, the 0.236 level was the site of more price action, having acted as support and had major price congestion, while the 0 level was only the tip of an intraday low. Lastly, you can see price began to congest towards the end of 2016. The first time price went past the 1 level, the fib began to lose reliability, incidentally at the same time while price began to congest, and the fundamental forces of the stock market were indecisive ahead of the 2016 US presidential election. The 1 level thus still did resist support and congest price, but it was losing reliability as a reversal point right at the tail end of the effective time range. Eventually, price absolutely rocketed up after the election was over and uncertainty had subsided. This left the fib level irrelevant, just as the effective time range and price range of the fib were passed. Continuing on with a related topic to the major stock market reversal in early 2016, we can use an example of oil prices to demonstrate characteristics specific to larger fibs. Larger fibs are just fibs that cover a larger price range and period of time. When compared to previous charts, this major reversal of oil prices in early 2016 is a giant in terms of the time frame and price range covered by the Fibonacci retracement. From one of the earliest possible trend lines in 2016, the effective time was extended for over 2 years. Before we talk about characteristics specific to large fibs, remember the two general characteristics for fibs of any size. These two general characteristics are related to decreased fib reliability moving out of the fib's price range and the end of the effective time range. Just like the previous example, fib reliability decreases as price moves past the price range of the fib, or when price is reaching the tail end of the effective time range. When both these factors occur simultaneously as they do here, fib reliability drastically decreases. The drop in reliability is also magnified with large fibs, since they cover larger price and time ranges. As for the characteristics specific to large fibs, fibs only have a limited number of lines, 7 lines to be exact. That means as they are extended over a larger price range, they can't cover every possible reversal area that can be more easily achieved when the fib is smaller and has less of a price range to cover. Usually, larger fibs mark price levels where larger reversals occur and often miss small swings. Levels on larger fibs are also less precise, and often see price drift above and below a fib level rather than cleanly reversing direction right away. Decreased precision is also due to the longer time frame. Price action in the confirmation triangle shapes the context of price action later in the fib. As time moves on, the influence and context of price action in the confirmation triangle often shifts or decreases. Like here, price action on the 0.382 0.5 and 0.618 fib levels in particular are quite reliable and relatively precise for a large fib. Price often reverses directly on these fib levels, or reversals happen after some minor price drifts above and below the fib levels. This is because the context is more recent and relevant. The relevant levels predicted by the fib turn out to be more reliable because they're closer in time to the influencing price action from the confirmation triangle. When using the confirmation triangle, we can see, even though price is still in the effective time range, reliability gradually decreases due to the longer passage of time. The 0.7, 6, and 1 levels demonstrate this very well, as reversals don't occur exactly on these fib levels, or reversals simply don't occur on those levels at all. Lastly, the 1 level spans 3 years from the single reversal area in early 2015 at the very unreliable 62.58 price level. In late 2017, as price climbed to the high 50s, this level would indicate resistance was in the low 60s. However, this was over 3 years from the last confirmation point and nearing the end of the effective time range. Thus, the 1 fib level at 62.58 would just be a rough indication of a resistance area in the low 60s, and you wouldn't rely on it as a highly certain resistance area. Eventually, this low reliability was confirmed as oil prices returned well above the low 60s in 2018. The next 4 charts demonstrate the features of price stalls and congestions at fib levels. Reversals aren't always quick. They don't always resemble shapes like the letters V, W, M, or N. Instead, they sometimes look more like the letters U, L, or J. When price enters prolonged sideways action, this indicates indecision. Price stalls and congestions at fib levels can be used as further confirmation that those fib levels can present support and resistance in the future. Flat movement may also occur before a breakout or continuation of price above or below a resistance or support level. It doesn't matter if price is before or after a confirmation triangle. The point of these 4 charts is to show price sometimes stalls at fib levels before reversing or breaking past a resistance or support, instead of just sharply and quickly reversing direction. These features commonly appear due to indecision before or after a major event, such as an earnings report or economic announcement. When there's no major news event, it may also happen when price is approaching new all-time highs or lows, and the market isn't sure if price will continue in its current direction. The next 2 charts show another phenomenon found at fib levels before or after a confirmation triangle. This is the presence of price breakouts, price breakthroughs, and gaps through fib levels. All this just means price rapidly moves through a fib level with higher volume and a larger price move. The vast majority of the time this is the case, but nothing is a complete guarantee and there are exceptions. The small areas marked in yellow demonstrate this. These are areas where price passes a fib level without a significant increase in price movement or volume, which is less common, but it happens occasionally. In the case of charts without volume, such as some commodities or currencies, you can still observe the phenomenon. However, volume will of course not be present. Only large price moves through fib levels will be visible. The following 2 charts show price breaking through a critical level. Here it is around 21 to 22 that can be identified by different fibs. You can draw your fib from any point as long as it meets the confirmation triangle criteria. We can also see the characteristics of price breaking through fib levels discussed earlier. Price movement through the 0.236 fib level with volume spikes. The following 5 charts demonstrate fibs used in the intraday time frame, with each candle representing 15 minutes. Basically, the characteristics of the intraday charts seen up to this point can apply to the intraday time frame too. However, fibs are a little bit less reliable in the intraday because this shorter time frame is often more volatile. Here are charts showing fib principles also apply to low dollar stocks under $20, even penny stocks with low and high volume in short, intraday, and long interday timeframes. Again, fibs are less reliable here because penny stocks are more volatile. Before looking at strategies to enhance success with fibs, remember that the key to greater success with fibs comes from understanding the context of where price is moving to in the fib. Certain areas in a fib can become more significant than others depending on the current position of price in relation to past price movements and fib levels. Keep in mind, each method of enhancing success is optional. They're not necessary or practical in all cases. In addition, you can choose to use one or a combination of all of them with concepts we just covered on fib retracement basics. No one method is better than the others. In some cases, some of the following methods will not be possible on certain charts. When combining 2 fibs, one large and one small, it's often better to combine no more than 2 fibs because it can become redundant and or confusing as the chart gets more cluttered. This example of FedEx stock chart demonstrates several features of a combined large and small fib that increase success. Focus attention to the reversal in the 220s occurring from June and July. The support zone in the mid-220s was identified as a major area of significance since at least late April. This area emerged as the most critical support zone where a major reversal was likely to occur due to several factors. First, let's begin by explaining the formation of this key support zone. Near the end of 2017, the broad area in the low 230s to low 220s acted as a strong resistance with several small reversals. Eventually, this area was passed to reach new highs on higher than normal volume and price movements. Even before drawing a fib, the large amount of significant price action and volume presented were early indications of an important zone. The second major indication emerged when FedEx and all global stock markets had a sharp downtrend. In late January 2018 to early February 2018, the reversal of this significant downtrend would be very important, even if it was isolated to FedEx alone. However, since the sharp downtrend was also seen across stock markets around the world, this added extra importance to the downtrend and subsequent reversal back up later in February 2018. Regardless of what fundamental influences created the price action above, the chart displayed enough price information to draw both fibs by mid-February to early March. The key reversal points to reference here are the high in early 2018 at the 270s and the low in early February in the 220s. After drawing the two fibs, the effective range could be increased, as we can see by the many swing points from which trend lines could be drawn after early March. Given this prior price action in the mid-220s and the close proximity of a large and small fib level in this range, a major area of significance was identified by the end of February. The swing lows in late March with high volume near this level also added greater validity. This second swing low in late March didn't touch the exact fib levels in the mid-220s because the prior swing low in early February was on exceedingly high volume and a large price move. This led to the support potential being raised slightly above the fib levels. The lining up of these two fib levels with significant reversal areas formed a strong and relatively narrow support zone. An entry price for a buy order is represented here by the line at 226.12. You don't have to be exact, it will be near impossible to get the absolute bottom price. Any price roughly near a zone where a large and small fib converge is sufficient. This price can also be fine-tuned by lining up the fib level or zone with one or more major prior reversals. Here you can see both these characteristics making for an excellent entry point at a high probability support price zone. Identifying these two characteristics will result in a sufficiently precise entry price that is in between the large and small fib, or slightly below or above them. In theory, the areas covered by fib levels from both the large and small fib are the most significant price ranges where reversals are more likely to occur. Areas of support and resistance identified by only a single fib are generally less significant. However, as we can see, this is only partly true on this chart. Case and point the downward reversal at the single small fibs 0.786 level in early June. Placing greater importance on price zones just because they're formed by levels from a large and small fib isn't enough. To further increase success, we need to determine which fib levels are more relevant. To do this, we first look at the areas where fib levels from the large and small fibs are very close together. In this case, 3 levels: the mid-270s at the 1 level for the small fib and 0 level for the large fib, the mid-240s at the 0.382 for the small fib and the 0.236 level for the large fib, the mid-220s at the 0 level for the small fib and 0.382 level for the large fib. Naturally, the combining of levels from both fibs outlines a rough price level or price range where reversals are even more likely to occur. Out of the 3 price areas mentioned, the one in the mid-240s can easily be disregarded as a relevant and major reversal zone. Even though it's a zone formed by a large and small fib level, it was never the site of a major reversal for the length of the entire chart. That's not to say it should be ignored completely. Rather, it has far lower consideration when compared to the mid-270s and mid-220s, where moderate to major reversals can clearly be seen. This builds on concepts of the confirmation triangle to further increase reliability and help to narrow down which price ranges warrant more attention. Specifically, this example highlights the importance of referencing to see if the fib levels also line up with past reversal areas. It's not reasonable to emphasize certain price levels just because one or more fibs approximate a certain price range. Using additional methods such as checking to see if past reversals occurred at that level or zone serves to improve reliability and success with fibs. When looking at reversals that occurred at price levels from only one fib, here it's the small fib, we notice some key features. These reversals line up with price ranges that have had one or more reversals clearly visible. In this example, we can see them on the small fib at 0.618, 256.50 in April, 0.236 to 38.33 in early May, and 0.786 to 64.48 in June. The first two reversals could have been easily confirmed with greater accuracy because they lined up with past reversals at those fib levels too. The third one at the 0.786 fib level is a special case. It would appear there was no reliable additional method to confirm a reversal was more likely to happen at that fib level. However, there was a clear reason, that being price was becoming overextended. Generally, price can move through two levels on normal volume without stalling or reversing. Once price moves to 3 fib levels without stopping to stall or reverse, the chances of a reversal increase significantly. If there's a reversal, it's also likely to be larger. This is because price can't normally maintain movement in one direction for more than 2 fibs without at least a brief increase in volume to sustain the trend. On this chart, price continued an uptrend after reversing off the 0.236 level for 4 fib levels to the 0.786 level. Additionally, this extended uptrend was also on normal volume with no major increases in volume in the period from May to June. Since volume was normal here, price was on a healthy uptrend for at least 2 fib levels. But after that, the absence of major increases in volume indicated unsustainable upward movement. Price did begin to stall between the 0.5 and 0.618 level. After passing the 0.618 level, 3 fib levels had been passed and the uptrend was becoming overextended. Eventually, after stalling at the 0.786 level, price regressed back to normal behavior, and the inevitable reversal back down came, due to the absence of major bullish volume spikes to sustain the uptrend. The downtrend off the 0.786 level moved down 5 levels to the 0 level in the small fib. At that point, the downtrend became overextended and reversed. Price movements in a fib can be thought of like an elastic band. The further price moves or stretches, the greater the chances are a rebound will occur, and the chances of that rebound being a large reversal are also greater. Overstretching begins after price has moved through 3 or more fib levels without an increase in volume to sustain the trend. Lastly, a small note about trend lines, specifically using the trend line from the confirmation triangle as a sign of a future reversal area. On this chart, that would be the reversal in early May on the small fibs 0.236 level. Trend lines can be used from the confirmation triangle or drawn separately to indicate the general area and time a reversal could occur on a particular fib level. This is just a minor additional method to enhance fib reliability. Trend lines are useful, but not necessary. They're often misinterpreted and misused on charts because they're easily drawn. All you need is 2 swing points or more to run a line through. 2 points on a chart can easily be manipulated to draw a line that will indicate any area you want to be a likely reversal area. Use trend lines carefully and sparingly in the context of a fib. The next chart demonstrates why it's unnecessary to combine fibs of near equal size. This causes a mess of overlapping fib levels. The better route to take is to have the larger fib be a minimum of 2 fib levels larger than the small fib to avoid a cluttered chart and redundant price identification. This chart is a cleaner chart and identifies the most relevant fib levels more clearly and with higher validity. Having the large fib 2 fib levels larger is just a minimum. Generally, the best size difference is a large fib 3 levels larger than the small fib. Usually, the 0.5 level of the large fib lines up with the 0 or 1 of the small fib, depending on whether the small fib is an up or down trend. This more clearly highlights the areas of greater significance. Normally, this means for every large fib level, there are 2 small fib levels in between the areas where the fibs overlap. The levels at the high and low of the small fib are normally easily identified as significant price ranges. Naturally, this is the case because these are moderate to major reversals that formed the high and low of the small fib. These are also 2 levels that line up with the large fib. The low or high of the small fib normally line up with the 0.5 level of the large fib when the large fib is 3 levels larger. The rest of the fib levels in between are not as easy to identify. As we've seen in this and the previous examples, the small fib levels that are close to the 0.236 and 0.382 levels of the large fib don't always form more significant zones. Remember, we have to see if they also line up with past reversal price ranges. In this case, the 0.5 and 0.618 small fib levels are about equal distance from the large 0.236 fib level. We must only choose one small fib level to form a zone with the large 0.236 level. Here, the 0.618 small fib level was chosen because it lined up with more past reversal areas that were more numerous and significant in terms of the length of the reversals. By revisiting these previous examples, we can see they only used one single fib, in that case, a single large fib. We can see the added benefits of combining fibs, in this case, a small fib. while at the same time observing characteristics such as combined fib lines referenced with past reversal points to better identify the most relevant price zones. Note the increased importance of price ranges formed by the small and large fibs that line up with past reversal areas. We can also see there are some reversals just below the 2571 to 2520 range because some of the past swing points had large price movements on higher volume, which lowered resistance force. These charts demonstrate the drop-off in effectiveness that normally occurs when the large fib is 4 fib levels larger than the small fib. Key areas of greater significance are still revealed at areas where fib levels from both large and small fibs are close and line up with past reversal areas. However, certain areas are missed in the middle levels between the high and the low of the small fib that were identified using a large fib only 3 levels larger. For this reason, if it's possible, it's normally best to have the large fib 3 levels larger when combining fibs. Anything more or less usually leads to mistaken identification of price zones that are more important. Unlike this chart, a large fib doesn't cover the 25,300 to 25,100 price range, where significant levels were identified using a large fib only 3 fib levels larger. When combining a large fib from the daily time frame with a small fib in the intraday time frame, it's best to split the charts into both time frames and have them side by side. This allows for a more clear view of the more significant and relevant price ranges. The same principles from the intraday time frame still apply to the intraday time frame, but as mentioned before, fibs are less reliable since this time frame is more volatile. Next is a detailed example of price development that combines everything we've discussed thus far. The end result is highly accurate identification of the most relevant and significant support and resistance zones marked in advance of major price reversals. The large fib here is at least 2 fib levels larger than the small fib. Also note here, unlike the other examples where there was one fib with an up and one with a downtrend, this one has both fibs in an uptrend. Both fibs may also be in a downtrend, it doesn't matter. By now, you'll notice the areas marked in yellow show areas where fib levels from the large and small fib are close together to reveal the approximate price ranges that will present support and resistance, and be likely areas of reversals. In theory, this concept of combined fibs reveals the most relevant areas where price is more likely to reverse. On the next chart, we can see the additional concept of lining up fib levels and zones of a combined large and small fib with past reversal areas. This marks the approximate areas where price is likely to reverse. The remaining areas not highlighted are single fib levels. Normally, these would be less relevant and significant compared to areas where combined fib levels encompass past reversal points. However, in this example, both single fib levels, the small 0.236 and 0.5 levels, line up very cleanly with past reversal points. Thus, while they don't combine with a large fib level to form a zone, they do have a proven track record reversing price. A combined fib zone is one form of extra validation, as is lining up fib levels with past reversal areas. When both these elements are combined, a reversal is even more likely to occur at that particular price region. Here we'll see exactly how price behaved. We will also see the areas with more confirmation generally became the areas where price reversals occurred, and these price reversals were also generally larger. After a steep downtrend from the triple top reversal in early 2018, price reversed sharply back up at approximately zone 1. It went slightly below what was originally drawn, but that's to be expected due to the major downward reversal on exceedingly high volume. Price overshooting is very normal. The next two upward reversals, 2 and 3, were well within their respective zones. Note how they didn't have price overshoot. This is because price was not in a sharp downtrend and or on exceedingly high volume like reversal number 1. The downward reversals marked in red also follow a similar pattern and don't overshoot, as price movement and volume were normal and not exceedingly high. Next, focus on the highlighted zone where reversals didn't occur, namely the 0.382, 312.54 large fib to 0.618, 308.63 small fib range from June and July, marked with a gray square. Price stalled at this zone for 2 days in a row before resuming back down. Eventually, price passed this area on the downtrend in June because there was sufficiently higher than normal volume. When price went through this zone on the upside later in July, it passed on regular volume. This is normal because in the context of both the large and small Fibonacci, price only went back up through 2 fib levels. If price passed this zone on regular volume after passing 3 or more fib levels in the small or large Fibonacci, this would be rare. The 0.531905 small fib level is highlighted in purple. It demonstrates the concept of a single fib level being an area where price is less likely to reverse. It also demonstrates that even though it's a less relevant level, it shouldn't be outright ignored. Here it exhibits the other characteristics of fib levels that are not complete price reversals. That is to say, it acts as an area where price is temporarily supported or resisted, meaning up and down trends were temporarily halted. Price is stalled or congested around the fib level before resuming its previous direction. Furthermore, price action during these stalls or congestions is very low, meaning no major moves in price take place. Volume also typically remains normal or slightly below normal. When price does move out of these stalls, it usually does so with larger price action, a larger move in price, and on normal or higher than normal volume. Again, we see these principles also apply to price charts for other markets outside the stock market. Here, we can see all the principles discussed earlier at work. The most relevant resistance and supporting price ranges are identified in advance of future price reversals. The large fib is at least 2 fib levels larger than the small fib. Areas where fib levels from the large and small fib are close to each other and line up with past reversal areas accurately identified future reversal zones. This is especially true for the areas marked in yellow. The price range marked in gray demonstrates the situation where price stalls or congests rather than completely and immediately reversing direction all the time. Moreover, price never moved 3 or more small fib levels after reversing to reach the gray zone. Thus, price still moved in a normal and healthy trend through the gray zone in early to mid-2017. It was never overextended by going past 3 or more fib levels. Later, as fib levels are redrawn to reflect developments in price, we can see these same characteristics again at different price zones. The upper range of both fibs now line up in the mid-1300s range. Though the 1270s to 1280s area still has fib levels from the large and small fibs lining up with past reversals, there is price congestion rather than reversals. It was also broken through by large price movements in early 2018. Conversely, the 1240s now act as a reversal area rather than just stalling or congesting price as it had done on the previous chart. In this next example, we see the same principles at work with a currency pair, euro to British pound. Several things to note right away. While there are levels from both fibs converging, some levels are closer than others. The zone marked in purple is a range where 2 levels are not as close as the others. Here you can see price congested or stalled rather than completely reversing in 2016. In 2014, the reversals around the 0.8 price level do line up with the 1 level of the small fib, though they're small reversals. They are reversals nonetheless. Later in mid-2016, price returned to the 0.8 price range and reversed off resistance again before price finally broke through this level in late June 2016 with a large price move. Normally, when the ranges between the combined large and small fib is closer, they will be areas where reversals are more likely to occur, and those reversals are usually larger. We can see this with the reversals in the narrower zones marked in yellow. The wider zone in purple still resisted or supported price, but price was stalled or congested rather than completely reversing, like in the narrower yellow zones. We also see with the zone formed by the 0.618 small fib level at 0.7597 and the 0.38 large fib level at 0.7640 that a price range marked by 2 combined fibs is still reliable even though it doesn't line up with any major reversal areas. On this chart, you can see more clearly in 2015 that a minor reversal and price congestion occurred. These areas are marked in blue. Though minor, the small price congestion and minor reversal are enough to add the additional confirmation that this area had demonstrated features of support and resistance in the recent past. From these examples, we can see fibs and price action don't always follow theory and concepts down to the smallest detail. Sometimes the combined fib levels form a range that isn't as narrow as we would like. Sometimes price zones don't always line up with major reversals, or they only stall price. These charts demonstrate that the concepts outlined are general characteristics that increase reliability of success when using fibs. Again, nothing is ever a complete guarantee. These methods merely identify areas where support and resistance are likely to occur. As you have seen, they usually reveal the areas where reversals will take place, but a minority of the time this isn't always the case. Just one more note to mention concerning the large fib. You can see the characteristic of large fibs not covering all reversals. Price does stall and reverse at the large 0.786 fib level. However, the 2 reversals in the upper 0.8 area were not identified by any fib levels. The 1 level at 0.8782 from the large fib is close, but those reversals from July to September 2016 don't touch any fib levels. 3. When? Now that we've covered all the basic and advanced concepts of fibs, there are still 2 more methods of increasing success and reliability. These fall into the broad categories of combining fibs with technical analysis and fundamental analysis. This section will be brief because everybody has their own unique preferences and capabilities when it comes to the degree of technical analysis and fundamental analysis they are able to use effectively. Combining fibs with one or both of these categories is a complementary addition rather than a necessary component of using fibs effectively. For a quick refresher and reminder when using technical analysis with fibs, we already discussed the use of resistance and support levels and price ranges. These are mainly past areas where price reversed direction. Along with that were trend lines, which roughly indicate the overall direction of price and a general time frame when a particular price level may offer greater chances of a reversal. As well, we saw the effects of low, normal, and high volume mainly applicable only to stock charts. These are among the most basic and essential concepts of technical analysis that are integral to fibs. In addition to these basics, one could choose to apply concepts from chart patterns and seek further confirmation from technical indicators of their choice. In many of the charts presented, you can see certain chart patterns coincide with significant price levels identified in the fibs. For example, you can see the major triple top reversal from the Lockheed Martin stock chart example. A triple top is a major reversal pattern, and in that case, it dropped price past the previously strong support at the 330 level. At the same time, price also broke below the strong trend line that formed the confirmation triangle. Furthermore, that 330 level became a major resistance area when price moved back up. On multiple occasions, price often reversed or stalled in the mid to high 320s before even returning to the exact breaking level in the 330s. This highlights a core concept of technical analysis whereby a previous area of support that price breaks through becomes an area of resistance. The opposite is also true when price breaks above an established resistance price range that becomes support when price returns back down to that area. In this example, there was a similar scenario where the 0.382 fib level at 159.01 switched between resistance and support several times. The same can also be seen in the FedEx example in figure 2.1, around the 227 price range. These next few charts will present examples of fibs combined with technical analysis based on charting patterns. This chart shows price trading within narrow rectangular ranges that are approximated by the 0.5, 0.618, and 0.786 fib levels. Price also breaks through these rectangles to enter or exit them with large price movements and higher volume. Price moves a total of 4 levels in each case. Remember, price is stretched and needs extra volume to easily pass through 3 or more fib levels. Also, you can see a major gap down in early 2017 through the 0.236 and 0.382 levels on very high volume. Coincidentally, this was after a decrease in trading activity leading up to a quarterly earnings report. A fib was drawn in early 2018 using the first upswing at the 0.5 level to form a confirmation triangle. This confirmation triangle became an ascending triangle. Price was supported on the trend line at the 0.5, 0.382, and 0.236 fib levels, which was often on higher than normal volume. Price also held firm resistance at or very near the 0 level to form the flat top of an ascending triangle. Price eventually finished the ascending triangle pattern by moving past resistance at the 0 level after the third bounce off support. This chart shows a head and shoulders pattern that lines up with the 0.236 fib level, where the neckline is formed to act first as a major support and later as resistance. These are just a few examples of chart patterns coinciding with fib levels. The list can go on and on. Significant levels identified by chart patterns often occurred near fib levels, which are also significant in themselves. If you don't use chart patterns for whatever reason, that's absolutely fine. Using fibs without them is perfectly functional. As with the other methods, using chart patterns alongside fibs is no different. They are complementary and optional additions. They are not entirely necessary for the effective use of fibs. As for the use of technical indicators with fibs, you count the use of the 20-day average of volume as an indicator. It can be used to get a rough idea of what is normal volume. This is mainly because there are 20 trading days in 1 month, and it is generally a good indication of the current normal level of volume. Just like with chart patterns, as long as technical indicators are in agreement with concepts of fibs, they can add additional validity to fib levels a majority of the time. That means an indicator identifies a fib level or zone as being a potential area where price is likely to reverse, congest, or stall. On this chart, you can see the 20-day and 200-day moving averages indicated the approximate levels of some reversals that also occurred on fib levels. The moving averages also mark the same area as the 0.236 level near the end of 2017, where price stalled instead of reversing. Remember, stalled or congested price is another characteristic of price behavior on a fib level. This example shows moving averages because they're among the most common technical indicators, if not the most common. Similar to chart patterns, you may choose to use some other technical indicators of your choice, or you can use none at all. They are complementary and not necessary. A general rule is to avoid using too many indicators, especially ones like the moving average, because they can cause a lot of clutter on already crammed charts. This is especially true when combining two fibs like the Lockheed Martin chart from earlier. As you can see, the chart becomes even more cluttered with just two indicators added. On to combining Fibonacci retracements with fundamental analysis. Fundamental analysis, such as information about the state of a particular business or economic sector, can also be used with fibs. This approach is geared more towards long-term investors, but can still be used for shorter-term trading. Like the use of technical indicators, you can choose which types of fundamental analysis to incorporate into your analysis. Fibs essentially outline price levels of interest driven by a fundamental event or influence. Earlier, we saw such a situation, which identified key price levels that presented resistance and formed trading ranges during the recovery of oil prices in 2016. Back on this chart, a nice entry point was identified in the high 220s. This major support zone discussed earlier presented an opportunity to profit from an exaggerated negative reaction to the earnings report in June that started the sharp and short-lived downtrend. Now, even though we've seen plenty of examples of how useful and reliable fibs can be at identifying significant price levels, you probably have greater confidence to use them successfully. Fibs are certainly among the best methods of price analysis, if not the best. They are simple to draw and are highly reliable when they present sufficiently strong confirmations. However, be careful, such a perspective can be dangerous and lead to false confidence if the limitations of fibs are not understood. There are certainly limitations to fibs, some of which have already been discussed repeatedly. A refreshing reminder of the limitations discussed thus far is in order. Fibs lose reliability as they approach and eventually pass the end of their effective time range. A significant drop in reliability occurs after price has passed the end of the effective time range, marked by the length of the trend line that forms the confirmation triangle. Fib reliability can drop significantly after price moves past the price range of a fib marked between the 0 or 1 levels. Larger fibs are less precise. They tend to miss smaller reversal levels and are less exact with the reversal levels they do identify. This is especially true when fibs cover a time frame of 2 years or more and a price range of 30% or more. Generally, large fibs are best used to gauge long-term trends and identify an approximate area where major reversals are more likely to occur. Large fibs, especially when combined with small fibs, are best suited for identifying larger reversals and trends rather than small and short-term price movements. Fibs are also less reliable in the shorter intraday timeframes, mainly due to the higher volatility associated with intraday price movements. As well, trading activity and volume, when volume is present on the chart, isn't distributed as evenly as it is on the daily time frame. Often, the bulk of trading volume and large price movements happen at the open and close in the case of the stock market. Even when none of the characteristics outlined above are present, it's critical to remember fibs are just guides and approximations of price movement. As mentioned many times before, nothing is a complete guarantee, and fibs are no different. Even under ideal circumstances, there is still the possibility fibs can be wrong. If fibs are not wrong, there is also the greater chance of misunderstanding and misinterpretation. Though not mentioned earlier, you may have already noticed on some charts you could be waiting a very long time for price to form enough reversal points to draw a fib with a confirmation triangle. In some instances, appropriate reversals from which to reference and draw a valid fib just takes time to form. Lots and lots of time. Further limitations can arise due to the reliance and need to reference past price action in order to draw a valid fib. The name Fibonacci retracement inherently implies the past. The re in retracement in the context of price charts means future price movements will follow a path influenced by past price movements and behavior. This doesn't mean price will necessarily copy the exact course of the past in reverse or stall exactly at the fib levels identified. Rather, fibs are severely restricted or completely non-viable when price moves into new all-time lows or highs. In such situations, price literally enters uncharted territory and fib retracements can't be used effectively. Since this lesson focuses on Fibonacci retracements, and to be more specific, fib numbers between 1 and 0, all analysis is limited to charts where price has not reached new historic lows or highs. There are certainly methods of predicting and forecasting price behavior when a chart enters new all-time lows or highs. Some of these methods are based on Fibonacci principles. However, that is beyond the scope of this lesson. To learn more about those kinds of topics, check out the lessons on other fib tools that have already been released. Overall, Fibonacci retracements are very useful for analyzing price charts. Given the knowledge of Fib features and price behavior explained and illustrated in dozens of examples throughout the lesson, you can now apply these concepts to real charts. Practice drawing fibs on old charts and see how future price behaves when you draw fibs on live charts. For even more on Fibonacci retracements, other Fibonacci tools, and indicators, follow us Sencor. Thanks for watching and have a nice day.